All right, let's talk about these government shutdowns. They generally last about a week, maybe 8 days. What's your outlook for this one, though? It seems to be a bit different. And then what's the biggest risk for investors?
So yeah, on average, we see that the shutdowns last about 8 days. Obviously, you had the one in 2018 and 2019, which was the longest one. That one was 34 days. We were originally thinking that this one was going to set up a lot like the one that we saw in 2013. That one occurred for 16 days. You actually had the debt ceiling that needed to be lifted that year, which actually created a catalyst for the shutdown to end. This year, though, you're starting to see that there's a smaller number of members of Congress that are actually blocking funding. And it's actually starting to anger some of the more moderate members within the chamber. So we actually thought that this one might last about 2 weeks, but we think that the bias is actually towards it being shorter. We do still obviously think we're going to get this shutdown come Sunday morning, but that there actually might be a little bit more political pressure to actually get a deal a little bit sooner. In terms of risk, I think the bigger thing is the longer the shutdown happens, then there's more risk to the Fed not being able to have access to economic data that would be either suspended or not being able to be reported. And then second, we're also watching just what's going to happen with Moody's. We've been worried that Moody's might put the U.S. on credit watch if we were to go into a shutdown, and particularly if it would be a protracted shutdown. And in fact, on Monday, they did actually say that it would be credit negative if the U.S. were going to go into a shutdown, not necessarily because of finances, but because this is more about process issues. And that's what the credit rating agencies have been more focused on in the past.
So there's some big issues for investors to look out.
That would be the third one. Not that we think we're going to get a downgrade, but that would be one step closer to a downgrade, and that would be a risk.
Okay, you're not the only person looking at what the potential impact to the Fed might be. So if a government shutdown lasts more than just a few days, there could be some, unintended consequences, especially for the Fed. Here's what Pershing Square's Bill Ackman had to say about that during our Delivering Alpha conference yesterday. Please listen.
Even in the relative short term, there are a number of reasons why rates can move a lot. Among them, right, we have a government shutdown. We're going into what looks like a highly probable government shutdown. We're going to have a data shutdown, right? All these little government agencies that put out data that the Federal Reserve relies on to decide whether to, adjust interest rates, then they're going to lose access to that data. So we're going to have this sort of kind of dark period.
So it sounds like you and Bill Ackman are kind of seeing things very similarly. Between the risk that you mentioned, the U.S. credit downgrade potential and also just the impact on the Fed, again, which one do you think is the most serious for investors?
In the short term, the Fed would be the bigger issue, because you're really looking at the Fed having a meeting at the end of the month in October, and they need to know what the economic data has been. The Fed has been quite focused on inflation being more hawkish over the past couple of months as they start to see inflation tick back higher. You've got oil prices moving higher. So I think that's the more immediate term. But for the longer term, that's where the Moody's piece would come in as more of a risk. And also, I would just note that this one is a little bit different in terms of a shutdown, because we also have other headwinds happening. We have higher oil prices. We have other things that are hitting the consumer, like student loan payments restarting and all that COVID aid rolling off. You have the Fed and inflation, and then you also just have U.S. debt going higher just because of higher interest rates. So those factors all together do create a little bit more risk this time. But again, we do think that might give you a bias to actually having a shorter shutdown, which would be more beneficial for the markets.